Welcome back to Bloomberg's Bottom Line. I'm Mark Crumpton in New York. Thank you so much for staying with us. For more on the anniversary of the biggest bull rally since 1955, let's bring in a bull who bought shares back in 2009 despite the highest level of bearish sentiment following the collapse of Lehman Brothers. Barton Biggs, managing partner and co-founder of Traxis Partners, joins us now on the phone from his office here in New York. Barton, welcome to Bloomberg's Bottom Line. Good to have you on.
Thanks, Mark.
The S&P 500 index, it's almost double since March 9th of 09. That's when it hit a 12-year low. The Dow closing yesterday's session over 12,200. It's up 87% from that 09 low. What's happened in the past 2 years? Is this the market correcting itself, or is something else at play?
No, I think the market at the bottom in March of 2009 was in a panic condition, and it appeared that the world economy was slipping into recession and deflation, and it didn't turn out that way. The so-called authorities did some right things, and the global economy has recovered. It's still fragile, but it's recovered, and so stocks have taken out the panic end of the world scenario.
Barton, you do mention panic, even with the market looking up. How do you change the psychology of some investors who are still fearful of getting back into the market after having been burned the past 2 years? When does the fear leave the market?
Well, the history is that the fear leaves the market very slowly, and then that's why the market, really the market for the last year and a quarter or almost year and a half has been sort of grinding its way up. It hasn't made dramatic progress. It made dramatic progress in the last 6 to 9 months of 2009. So the fear's gradually going away. It's the same thing. It always happens.
Our senior markets correspondent, Julie Hyman, was telling us during the commercial break, she quoted you. You said you don't think that valuations are stretched. Why not?
Well, I don't think valuations are stretched because the U.S. is at about 13 times forward earnings as produced by IBES, and Europe is about 11 times, and the emerging markets are about 11.8, 12 times, and those earnings estimates are, probably 3 to 4 weeks old, and they don't reflect the stronger numbers that have come through since then. So I don't think stocks are expensive here.
Well, this week Carl Icahn said he's returning $1.76 billion to investors in his hedge funds because he doesn't want to be responsible for, and his quote was, another possible market crisis. Is another crisis on the horizon because of the jobless rate, housing foreclosure situation, financial situation of state and local governments, and add to that the geopolitical concerns in the Middle East?
Yeah, there's another financial crisis on the horizon, but there's a lot of mist and fog out there between what you might be able to see and that crisis. And I'm willing to bet at this point that we're not going to have that kind of crisis.
Why do you say that?
Why do I say that? Because I think that for those things to happen, for house prices in the U.S. to fall another 10, 15%, which is what would be required for a real crisis, and for the unemployment rate is already coming down.
Right.
And as for the sovereign debt crisis in Europe, and I'm hopeful that the Europeans are going to get their act together in late March, and so I'm not there's always an end of the world scenario,
right.
And I think it's usually right to bet against it until proved otherwise.
Barton, corporations still sitting on the sidelines, a lot of cash on hand, billions in fact. When are they going to start to put that to work in the market?
Well, they already are. I mean, capital spending is in the U.S. Is increasing very nicely. In fact, it's very impressively. And corporations are buying back more of their own stock.
Right.
And corporations are making acquisitions for cash. So they're doing it. But again, it's trauma, and it takes a while to get over it.
Barton, in about 20 seconds, for investors looking to get back into the market, where should they be looking?
I think they should be looking in the U.S. and in big cap, high quality stocks, particularly tech stocks, and I think they should be looking in Asia, in markets like China, Indonesia, Hong Kong, areas like that.
In about 10 seconds, dividend-paying blue chips, are they the way to go?
Dividend-paying blue chips are a great way to go, the best way to go.
All right, Barton Biggs, Traxis Partners, joining us on the phone from here in New York. Barton, thanks so much. We appreciate it.
Thanks for having me.